Picture this. You've been doing everything right. You've been saving consistently for, I don't know, maybe 20 or 25 years. You've got a decent chunk sitting in your 401k, maybe 400,000, maybe closer to 6. You check the balance every few months, and you feel this quiet, warm sense of satisfaction, like you're on track, like the future version of you is going to be okay. And then one day, you sit down with a calculator, or maybe a financial advisor, and you start running the actual numbers. Not the balance, the real numbers. What those dollars are actually going to be worth, what the government is going to take, what a loaf of bread is going to cost in 20 years, and something shifts. The satisfaction gets a little cloudy, because the gap between what you thought you had and what you're actually going to have, it's not small. My name is Rick, and I've spent more time than is probably healthy thinking about money, retirement math, and specifically why so many people arrive at the finish line of their working lives only to discover that the number in their account doesn't actually mean what they thought it meant. I've talked to people who saved dutifully for decades, people who did all the right things by every conventional measure, and still found themselves quietly stressed in retirement. And a huge part of that, a part nobody really talks about clearly, comes down to two invisible forces that work against you the entire time you're building wealth: taxes and inflation. Not in some dramatic, obvious way. Quietly, slowly, in ways that are almost impossible to notice until you finally do the math. And that's what today is really about, because I think if you understand how these two forces actually work, how they compound against you over time, not just in some abstract sense, but in the very specific, practical sense of what it means for your retirement, you'll start making different decisions, and those decisions will matter a lot. So let's talk about it. There's a number you probably know off the top of your head, your retirement account balance. Maybe you check it monthly, maybe quarterly, and that number feels real, right? It feels like money. It feels like security. $500,000 sitting in a 401k feels like $500,000. But here's the thing, it's not, or at least it's not $500,000 in any sense that actually translates to $500,000 of spending power in retirement. And the reason for that is so straightforward, it's almost embarrassing that nobody puts it front and center when people are thinking about retirement savings. Traditional 401ks and IRAs are tax deferred, which sounds like a benefit. And it is in the short term, but it means that the government has a claim on that money, a significant one. When you start withdrawing in retirement, every dollar you pull out is going to be taxed as ordinary income, not capital gains rates, ordinary income rates. So if you're in the 22% bracket in retirement, which honestly isn't hard to hit once you factor in Social Security and a reasonable withdrawal rate, then your $500,000 account is really more like $390,000 of actual purchasing power. That's $110,000 that doesn't belong to you. It never did. Now, I'm not saying this to be alarming. I'm saying it because the math matters. And the reason most people don't feel it acutely during their saving years is that deferred taxes feel like no taxes. You put money in pre-tax, you watch it grow pre-tax, and psychologically, you start to think of that balance as yours, all of it. It takes a genuine effort of imagination to remind yourself that there's a silent partner in that account, and that silent partner is the IRS. A good way to think about it, and I find this framing really clarifies things, is to imagine you and a business partner started a restaurant together. You do all the work, you cook the food, you manage the staff, you build the customer base for 30 years. Your partner does nothing, shows up occasionally to check in, and then when you finally decide to retire and sell the restaurant, your partner gets their cut, 20–25% of everything. You knew this going in, technically. It was always in the agreement. But somehow, after 3 decades of building it yourself, handing over that share stings in a way it didn't seem like it would when you signed on. That's the tax-deferred retirement account experience for a lot of people. The actionable piece here is simple to say and a little harder to actually do. You need to be thinking in after-tax dollars, not pre-tax dollars. Your real retirement number, the one that actually represents your spending power, is your account balance minus the taxes you'll owe on withdrawal. And ideally, you're building a retirement strategy that accounts for tax diversification. Some money in traditional accounts, Some in Roth accounts, which you fund with after-tax dollars, but which grow and withdraw completely tax-free. Some in regular taxable brokerage accounts. Different buckets with different tax treatments, so you have flexibility in retirement to manage your taxable income year to year. Okay, so taxes are one side of this. The other side is inflation, and inflation is honestly